Hey everyone, Ryan Bolton here. I am a mortgage nerd. So today I want to show you how to fill out a mortgage application. I know this can be a really intimidating part if you have issues with your credit or job history, you just don't know how to fill out one of these if you've never done one before. So I want to walk you through what the process looks like, what information to put in the box, why we need the information, just to help demystify the situation a little bit so you get more comfortable filling out the application. This is such a crucial first step if you're looking to buy a home this year because there's so many things we can do to help you with your credit or get you ready for the best possible loan if we have a little more time to work on your pre-approval. So I cannot emphasize this enough. Get pre-approved first before you start looking at homes or walking through homes or submitting offers or anything like that. You really need to start this first step. So hopefully this will help you understand what's on the application, why we need it, and I'll walk you through step by step what it takes to fill out a mortgage application. Okay, the first place to start is going to my website, ryanbolton.com. Here's what it looks like. What a beautiful page. I mean, look at this. Oh, look at that handsome devil. Oh boy. Okay. Anyway, so here's communities I serve, just some fun little tips, information, blogs, all that fun stuff a website should have. Up in the upper right hand corner here, you'll see two little buttons here. You've got the apply now in red. This is where it'll take you right to the application, or you can book a meeting. This is a Calendarly link. If you want to book a call, you can even just call me. There's the phone numbers there. So plenty of opportunities to reach out. But for the purpose of the video, I want to show you what the application looks like. So we're going to go right here to apply now. This will pull you right into our loan portal, and this will start the loan application. So this is exactly what it looks like. It's really easy, real simple to follow along. So what I'm going to do is go through what each of these fields are and why we need it, kind of some tips on how to fill it out. But it really is very easy. Very few things are actually mandatory on here, which makes it nice as well. So first thing here is right here is who is referring you. So if you are working with a builder, a real estate agent, you just want to put their name there. Are you currently working with a loan officer? You want to hit yes, and you'll want to go to my name in the drop down. So Ryan Bolton down here, right here. And then the purpose of your loan. So you'll see a drop down. Is it a purchase, a cash out refi, or a no cash out refi? So if you don't know, you can select whatever. We can always switch it later. But for the purpose of this, we're going to use it for a purchase. Right here, you can put in your estimated purchase price. You can leave it blank if you don't have a purchase price picked out, or if you have a home or a price range or something, you can put whatever you need to there in the box. But it's not even mandatory, but just something if you have an idea of a home you're trying to approve for, that type of thing. If you have a down payment, you can put that here. If you don't, you can leave it blank. You can do it as a dollar amount or as a percentage. So then you scroll down here, hit the next button. The next section here is what is the use of the property? You have primary residence, secondary home, or investment home. So these classifications are really important because we need to know how you're going to use the home. A primary residence is going to be a home that is where you're going to live most of the time. You're going to send your pay stubs, your W-2s to that address. It's where you live most of the time. It's really your primary home. A secondary home is more like a vacation home where maybe you live 6 months a year in a snowbird area and other months in the summer months or something like that, or family members use it. It's a cabin, or it's just something where it's not your primary, but it's not rented out. It's not something where you have a VRBO or rental or something like that. You can have some of those rentals with a secondary home, but generally speaking, it's not something where you're using the rents to qualify for the loan or showing you will rent the home out. It's truly another residence that you can use anytime you want, more like a vacation type residence than something that you use all the time. And then investment home is when it is rented out, either VRBO full time or got a long term lease, something along those lines is those designations. So there's certain loan programs that don't do second home or investment homes. So that's why we need to know what your use is going to be. Now, it can change. If you fill it out and something changes, we can always adjust it. So by filling out anything on the application, if it's wrong, we can fix it. So it's something where it's just designed to kind of get an idea where you're at. So for the purpose of this video, we'll just select primary home. Next one is if it's a joint account. So this means if there's a co-signer or a spouse or a family member or something that's going to be on the loan to help you qualify. So most common is going to be two borrowers in this form. You're going to have a husband and wife. That's probably the most common, or maybe a father and a son, a mother and a daughter, something where it's a family member that's helping a family member purchase a home. But I've seen as many as six borrowers on one application. So it's not uncommon for there to be more than two, but I'd say the most common is two. But just for the simplicity of this, we're just going to go with one. Next, right here is where you do have some mandatory stuff, at least your name and phone number. So I'll just put my name in here real quick, just so it gets us past the screen. And then just an email. I'll just put, screen out of the way here. They'll just have something in the box here. So this is where you put your date of birth, social, citizenship, marital status, number of dependents, cell phone, phone numbers, that type of thing. But you can see this is actually not any of this is mandatory, but the more you fill it out, the more accurate our pre-approval is going to be once we can fill out these certain things. Date of birth really just ties into that you're old enough to sign a contract. By law, we can't discriminate. So you can get a 30-year fix if you're 90 years old. So there's nothing that says that there's a discrimination against the age. You just have to be of age to be able to sign a contract, legal age of 18 in most states. So then down here, if you have any military service, you can check the box yes or no. This may open up the opportunity for certain loan programs if you do have some sort of military service. So you can check the box if that works for you. So we'll hit next. Next one right here is your residential address, so your current address that you're living at. You'll see here that we want to know the time you've been in the address. So you can put the address, unit number, if there is one, city, state, zip, county. You can put all that information in. This section is important of how long you've been at that address. We do require a 2-year job and residential history of where you've lived, also to show that if you qualify for first-time homebuyer programs, to show you haven't owned a home in the last 3 years. So if it's been less than 2, you'll have to add a previous address right here. So we recommend entering a 2-year history. If you don't remember it or can't remember it right off the bat, we can always get it later. But your current address is definitely really important for this first step. And then you would select the drop down here, whether you own the address that you're at, whether you rent that home, or whether there's no primary expense. So that means that you're living with a family member and this is going to be your first home, or maybe you had to move back in with a family member. Now you're moving back out to buy a house. So just need to know if there's an expense with that residence. Then if you have a different mailing address, so like a PO box, or you mail stuff to a business address or something like that, you can put in a different mailing address if you need to. So we'll go down here and hit next. Next one is a schedule of real estate. This shows if you own any other real estate that we need to account for debt ratio or income purposes or anything like that. Now, I've had people that have properties that are free and clear and they don't put it on here thinking, well, there's no mortgage against it. There's really no reason to list any other properties, but you still have expenses with that property. You're going to have property taxes. You're going to have homeowners insurance and maybe an HOA, depending on the property, may have some sort of HOA. So we do want to list any other properties that you have on here, and I can help walk you through that. We can go off tax returns, we can go off credit reports. There's things we can find those addresses for you because some people don't always have those properties memorized. Like I've got a bunch of rental properties. I just call them either the city or the location or a name. I just have names for them. If you actually ask the address, I'd have to go, oh man, I think it's something east. So it's something where even I don't always have this stuff right on the tip of my tongue. So it's something where we can always gather it later. The idea is to try to get as much as we can initially, and then we can verify things as we go along. Next, right here is very important. It's your employment. We just need to know what type of employer that you work, if you're self-employed, if how you earn your income. And there's a couple different sections here on the screen as I'll show you. But the same thing as a residential history, we need a 2-year history of where you've lived and where you've worked. So this can be a little bit tricky if you've switched jobs during that 2-year time. Maybe you were W-2 pay stub working for a contractor or something like that, and now you're out on your own and you're self-employed. They'll want to see a 2-year history of self-employment or the type of income that you earn. That doesn't mean you won't get a loan if you made some sort of switch. It just may change what income they'll let you qualify for, or maybe they won't count your income at all until there's been that 2-year job history. So the most common thing you'll see is maybe somebody goes from a job where there's no bonus or overtime or commission or shift differential. I mean, people make their income all kinds of different ways. But if there is that shift from going from a job that doesn't have it to a new job that does, they won't let us use that extra bonus income until you have a 2-year history of earning it. So that's where part of this qualification finds out what income you're earning and how much we can actually count towards the loan. And honestly, if you are switching jobs from something that didn't have bonus overtime, self-employed, something like that, you do want to have a little longer history before you use that income, because a lot of times it's seasonal or it's based on workflow, or I mean, there's some industries that have overtime just baked in. But a lot of times it's kind of more, okay, we're busier in the summer, we have overtime in the summer or the winter or whatever it happens to be. So you really want that to be truly bonus income and not have to qualify with that income, because if it does go away and you can't make your mortgage payment because you were counting on it, it's something that can put you in a bad position. So the underwriting guidelines also kind of want to see what the true longevity of that extra income is going to be. But again, it doesn't mean you won't get the loan. I've had people that quit jobs and say, well, now I can't get a loan because I just switched jobs. I've literally done loans for people who haven't started their new job yet. We have an offer letter that says, okay, they're going to start on X, Y, and Z date. they're going to be making X amount per hour or per year, whatever their income structure is. We can still do loans in those situations. It's just about documenting it. It's just about showing how that income is going to kick in, when it's going to start, what type of position it is it similar to previous lines of work. So that's our job, is to find out what income you earn that we can actually claim. Self-employed is probably the toughest, because when you're self-employed, you'll write off a lot of your expenses, which makes your taxable income as low as possible, but then can hurt you for a loan. But we have loan programs that don't require tax returns. So that's part of my job, is to see what your situation is, get you the best loan that's available, or tweak what we need to get you ready for a loan down the road. It's right at the first of the year here, 2024. If you are self-employed, before you file your tax return for 2023, I can do a free review and say, okay, based on this return, this is what you qualify for. Then you can go back to your CPA or whatever and adjust your expenses or classifications, or just claim less expenses so you claim a little more income to qualify for a loan. I can't tell you how many times I've been able to review people's credit or tax returns, make little adjustments, and suddenly they can qualify for the loan they actually want without having to do a lot more to Uncle Sam, because we look at the taxes a little differently than what the IRS or what your CPA may look at them. So if you're in that stage of kind of prepping your tax return, you're thinking about buying a home this year, really, really recommend, whether it's me or another loan officer, just get it reviewed before it's filed. It's so much easier to tweak it a little bit than it is to amend it or go back or just waste the whole year until you have to file 2024's tax return. So really crucial point. If you're getting ready to file your taxes or just getting ready to prep them here at the first of the year, get them reviewed before they're finalized, before they're actually filed to the IRS. Okay, so let's look at the rest of this here. So you got start and stop date. Again, we want to see the 2-year history, your employer name, phone number, position, whatever you can fill out there, what type of income will be here, and then what your base, your average over time, just how you earn your income. If you have another employer, you can add that here, or a previous employer, you can add that. So if maybe you work 2 jobs, I know there's like nurses that'll work for a couple different doctors, maybe a couple days a week at one, a couple at another one, or they're in an office where there's a couple doctors, and so they get W-2s or 1099s from several doctors. So that is something where we can add secondary employment. When it does come to second jobs, they do want to see, again, the history that you've been able to maintain 2 jobs, unless it's an industry like the oil fields or nursing or something where it's common to have multiple people paying the same person, even though they're maybe sitting in the same office or working in the same office. So there is a guideline for everything. Every type of income out there, there is a guideline for it. Next is anything that's not employer based. So this is income sources. You can see in the drop down like alimony, child support, disability, dividends, pension, Social Security, VA benefits. I mean, there's all kinds of stuff there. So you can list that income there as well. And if you just have additional income, you can do it in many boxes as you need. So it's really flexible to make sure that we count all of it. And that's part of my job, is to find out, can we use that income? What are the guidelines for it? Like, for instance, child support, separate maintenance, alimony, there's rules on how we can use that income. For instance, if the child is going to be over the age of 15, so their child support is going to end within 3 years, we typically can't use that income. Even if the kid's going to be going to school, stuff like that, they usually go off the age of 18 when the child support's going to end. So that's something, if you're going to try to use that income. Now, if it's an expense, we also have to know about that to add that to the debt ratio if you are paying child support, separate maintenance, alimony, that type of thing. But we can review that with you on how that's going to affect your qualification. So that's the income and employment screen. So now we'll go to this one. So this is a screen that a lot of people just kind of stop at. They fill out that information, like, oh, wait a minute, I don't want to ding my credit. I'm not ready to pull the credit report yet. I'm just kind of trying to see where I'm at. This does not automatically pull your credit. But once we gather that information, we have to at least get consent to pull the credit. But the system doesn't automatically pull it. We don't want the system just randomly pulling credit reports without a chance to talk with the person first. I get leads that come in on my website, and maybe it's a state we can't do, or maybe it's a property we can't do, or they're looking for debt consolidation. I've had people that fill out the application not knowing it's a mortgage. So it's just good to go through and say, okay, call the client, kind of review it, make sure that there's no red flags or there's no other issues, and just get an idea where they're trying to go. We can also do a soft pull on the credit to just at least get debt ratio, kind of see where we're at, what we need to work on before we do the hard pull. But honestly, the sooner you can get that credit pull done, the better you're going to be, because this will allow us to see what your debt ratio looks like, what debts we can work on, what we can do to help you with your credit score. There's always little things we can do to get you in a better situation to be able to help you get a better loan. A lot of loan programs are based on 20-point increments. So if you're right at the 19th point, like right below the next tier, there's little things you can do to kind of bump up to that next tier. So say you're a 639 and 640, you get a better loan, or 660, you get a better loan, 680. There's little things we can do to know why your score is the way it is to just help you get it up a few points. Maybe it's paying off some debts. Maybe it's getting rid of revolving accounts. Maybe there's all kinds of different things we can do. And the sooner we know that, the sooner we can start that process. Credit repair usually goes on 30-day cycles. So whatever they've reported, you have to wait till the entire next month before they report again. So if you can kind of catch those cycles, you can get your credit score kind of boosted every 30 days or so. Now, we also have a rapid rescore. We have other ways to get the score up faster. It just costs more money. So if we can do it naturally, it's a lot better way. We can hit a lot more things. It's just better to try to start that process sooner than later, because I almost guarantee almost every credit, we can do things to help your credit score go up just a little bit. But this just authorizes that we got the information, that you're okay with us obtaining that credit report. But again, it won't automatically pull it. We will call you first, kind of review it with you first. Okay, we'll go to next here. This is e-consent. This just says that you agree to receive electronic documents, electronic signatures, a lot of those types of things. Now, when it comes to signing the actual loan, that's where we'll meet at a title company. That's when you'll go through notarize. It's an actual physical signature. But a lot of stuff at the initial stages of the application, of the disclosures, appraisal notices, all that stuff. If we get it digitally, we don't have to mail them to you. I mean, I think the initial disclosure package is like 40 pages plus this booklet that's like 25 pages. So it's like 60 pages worth of stuff that isn't even final yet. We're still in that information gathering stage. So by e-consenting, it saves on time, waiting periods, paper, mailing, stamp, all that stuff. So this is basically saying you agree to receive some documents electronically. So we'll go to next here. This next section is the declaration section. So we'll go through this. So these are questions that we ask to be able to pre-screen, qualify, see what programs you qualify for. So by checking yes or no, it doesn't mean you automatically don't get the loan. It just may trigger other guidelines. So let's review each one of these and kind of the why behind the question. First one's like we talked about a little bit at the beginning. Will you occupy the property as your primary residence? So you've got kind of a simple yes or no here. If the purchase, the next one, letter B here, if this is a purchase transaction, do you have a family relationship or business affiliation with the seller of the property? So there's different guidelines that pop up if you're a family member selling to a kid, maybe, or some sort of family relationship between the buyer and the seller. Doesn't mean you can't do it. It just triggers other guidelines to make sure that the appraisal is done correctly, that there's not any flipping schemes where you're basically selling back and forth, just keep raising the price, keep cashing out the property. Unfortunately, there's a lot of fraud in that arena where people will sell. In fact, I remember I think it was in Texas, there was this church that just kind of kept selling to each other in this whole community. Like 50 of them just kept going back and forth. And they just keep raising the prices because the comps would be there. It just kind of kept artificially raising the value of this entire community over like a 4-year period. So it is something where there is some fraud that is associated when you have too much of a cozy relationship with the seller of the property. But it doesn't mean you can't do it. It just triggers other guidelines with it. And then the next one right here, let me see. So we can when you check yes, there's a comment box. You can fill it out right there, or we can just get it from you later. And then right here, once you check if it's primary residence, it'll ask you if you've had ownership in the property in the last 3 years. So this is where even if you've owned 50 homes in the past, if you haven't owned a home in the last 3 years, you're reclassified as a first-time home buyer. So you could have had 50 houses in your lifetime. And when I think of first time, I think of ever, like first kiss or first, first ever, first time going to the movies. But in mortgages and in real estate, if you haven't owned a home in the last 3 years, 36 months, then you do requalify for first-time homebuyer programs. Now, that doesn't mean you have to use them. That doesn't mean you have to use that designation or anything like that. It just opens that back up if that's something you need. So that's just something there. So you'll hit yes or no. This will open up if you have owned a home in the last 3 years. What type of home? Again, was it a secondary home, investment property, all that? And then how did you hold title? Sole person, joint, that type of thing. So some of these boxes will open up other boxes as you go through them. So for the purpose of this, we'll just go no to keep the boxes easy and simple. We'll go no here on this one. So now we'll go to letter C. Are you borrowing any money for this real estate transaction, money for closing costs or down payment, or obtaining any money from any other party, such as the seller or the realtor, that would not be disclosed on that has not been disclosed on the application? So We need to know where the money is coming for to cover down payment, to cover closing costs, earnest money. We have to verify where those funds are coming from. Because if it's another loan and you have another payment out there somewhere, we just have to make sure we add that to your debt ratio. We also, a lot of money laundering happens by buying real estate. They'll come in, buy the property with cash or whatever, let it sit there, and then resell it. And suddenly there's a new transaction. That money has been cleaned through the system. So real estate has a lot of money laundering requirements, SARS reports, all kinds of things that we have to watch out for as money comes into the transaction. So anything down payment, closing costs, earnest money, we have to verify where those funds came from. Now, if it's a gift or a family member or some other type, we just have to document it. So the more we know about that up front, the more we can help you get that documentation ready as you're out looking for a home. And if it is a gift, the money doesn't have to go directly to your account. We just have to verify it with the family member, wherever it's coming from. It can stay in that account, and then it can go into the title company's trust account at the time of closing. So it doesn't ever have to hit your account. Now, if you already transferred it, they've already gifted it to you. Again, we just have to verify it. So it's just, these questions have a reason. There's always a why behind them. And the sooner we know about some of these things, the sooner we can get the documentation, and we're not scrambling while you already have a home under contract. We have deadlines to meet. They're just really important to have this stuff early. So that's really what I want to try to emphasize with all of this, is get it started early. This is really the first step. If you're buying a home this year, get this process started sooner so it's just smoother. And you just don't have this deadline of 30 days or 20 days or whatever it is to fix some of this stuff, when sometimes it can take longer than that. And you might risk your earnest money or just the contract, all that stuff. Okay. So we'll just select no. No, letter D here. Have you or will you be applying for a mortgage loan or any on other property, not the property secured of this loan, on or before the closing this transaction that is not disclosed on this loan application? So this commonly happens where maybe they need a loan on the exiting property to use as down payment on the next property, or maybe they're buying multiple investment properties all at once. So this is just designed to make sure there's no other loan in the process that's out there that we have to factor in for debt ratio, for down payment, for any of those types of things. So that's a really important question, because there is people that will use the exiting property or a property they're going to sell, do a bridge loan, something where they're taking money out of the equity of this home to buy the next home. We just have to know that that transaction's out there so we can know if it affects our debt ratio or where the funds are coming from, that type of thing. And then it kind of has a sub question here, D2. Have you or will you be applying for any new credit, installment, credit cards, mortgage loans, car loans, anything like that, on or before closing this loan that is not disclosed on this application? So the most common thing you'll see here is people will get their purchase contract, they'll get the appraisal, they'll get approved, they're getting ready to sign their loan, and they run over to a furniture store, get $10,000 worth of furniture packages and TVs and washer, dryer, fridges, whatever they need, and they'll put it on some sort of in-store credit, like Boulevard Home Furnishings, RC Willie. I mean, there's all kinds of stores out there, Ashley Furniture Store. So it is something where that can affect your approval, because not only does it add a new debt, it adds an inquiry. It can affect your credit score. So do not do a new auto loan or any type of new loan on your credit, a new credit inquiry, anything like that, until after the loan's completely done, keys are done, it's recorded, the home is yours. Then you can go out and get any new loans that you qualify for, no problem at all. But I've seen amazing amount. There's memes all over the place. Real estate agents will tell you that people go out and get a car loan, a furniture loan, something out there, and blow up their ability to buy the house. They do a soft pull before they fund the loan. They'll also check your employer, make sure you didn't get fired during the time we started, or your last pay stub or something popped up there. I've seen that happen. That's horrible when that happens. When you're ready to sign, all of a sudden they lost their job. They go in and sign on Friday and they lose their job on Monday, or lost it on Thursday or something like that. That's horrible. But these are final checks they will do before they fund your loan. So last thing you want to do is have it affect your loan, either delays. That's usually what will happen. Sometimes it's not a total deal killer, like a new car loan or Visa if the debt ratios are fine, but a lot, it just delays. And all of a sudden, if you delay your settlement deadline, you might risk your earnest money. You won't close on time. Maybe you've already moved out of a house. You got all your stuff in a U-Haul and you're sitting in a hotel. You just don't want to have that last second delay because of some new credit loan or something like that. So really, really, really crucial that you don't pull any new credit until after the loan's totally done. Next one right here is letter E. It says, will this property be subject to a lien that could take priority over the first mortgage lien, such as clean energy lien paid through the property taxes? So this is a clean energy program, some solar, mechanics liens, things like this. that essentially will record before your new mortgage records against the property. So if there is anything, any kind of work that's being done, maybe a pool's getting finished, maybe basements are getting finished, or a roof, or just stuff like that, you just want to make sure all that stuff is cleared before it actually ends up becoming a lien against the property. Okay, the next section here is about your finances. Letter F, are you a cosigner or grantor on any debt or loan that is not disclosed on the application? So a lot of times when we pull credit, we're going to see the loans, but if there's a car loan that's out there or some other signature loan or something that you have that isn't reported, we just have to acknowledge that, hey, yeah, I've co-signed for my brother, my family member, my son, my daughter, or something like that on a car loan. Now, a lot of times we can have guidelines to exclude that payment if they've had it for long enough, but most of the time you will be hit with that payment in your debt ratio and just have to make sure you still qualify for it. But there's guidelines to remove it, or there's guidelines to show they're making the payment. If you do have somebody that's doing a cosign, you really want to make sure that you can document they're making the payment. So either they make the payment directly and you get a copy of the bill pay history or the check, or they pay you and then you pay it. You just want to make sure you have that documentation that they've been paying it. As soon as you pay it for them, then all of a sudden it doesn't look like it's a cosign. You're on the hook for the loan. So that's where it's just better to just document a check, bill pay, some sort of proof that the money came from that person that's actually obligated on it. Or maybe it's to the point where they can refinance and get it in their name, take your name off of it. We have options there as well. But just kind of keep that in mind when there's cosigns. You are still on the hook. You signed the loan. That's why they gave the loan, is because maybe the risk of the son or daughter wasn't good enough to give them a better rate or get them the loan. So you co-sign to help them with the loan. So you're equally on the hook for that loan. So if they don't make the payment, it affects your credit, it affects your debt ratio. So it is something we have to document. Letter G, are there any outstanding judgments against you? Sometimes they don't show up on credit, depending on the judgment, depending on how they report, depending on if it's medical or collection or all kinds of different things. A lot of times the title company might find a judgment we didn't know about. Sometimes you'll see it with like divorce situations where a judgment might show up on the property. So it is something where if you know of it, it's just better to disclose it and we can work through it. There's payment arrangements or we have to pay it off or something like that. Letter H, are you currently delinquent or default on any federal debt? So this is any IRS tax liens. If there's any state stuff there, we'd want to get that too. Another one that is starting to pop up is student loans. If there's any lates or defaults on student loans, we just have to be aware of that as well. Letter I, are you a party to a lawsuit in which you potentially have any personal financial liability? So this one's most common with divorces because it's something that affects you more personally than maybe a business or something where you're having a dispute with a shareholder or something like that. But it's something where we want to disclose if you are party to some sort of lawsuit so we know how that can affect the property, how that affects your debt ratio, if there's child support, separate maintenance, alimony, something like that that's owed. So we do want to disclose if there is some sort of lawsuit that's pending. Letter J, have you conveyed title to any property in lieu of foreclosure in the last 7 years? So both J, K, and L are all dealing with foreclosure. There's really three ways you get foreclosed. You, one, just give the property back. That's a deed in lieu of foreclosure. So instead of doing the waiting periods, instead of going to the courtyard steps, instead of doing all that, you just say, lender, here's the property back. Here's the deed. It's now your property. Doesn't mean they still can't come after you. Doesn't mean they won't try to get the balance and you may have to do a bankruptcy for the difference or something like that. So it's not as common, but it is something where a lot of states it's a little bit more common. But deed in lieu is one of the ways you can avoid the full blown foreclosure. Letter K is if you've given a foreclosure in a short sale or pre-foreclosure, something where it started to go in foreclosure, but you were able to sell the house before it actually went to the courtyard steps and before it was actually sold. So, and this is a short sale is typically when you're selling it for less than the balance on the loans. So the lender agrees to say, okay, we'll take the lesser amount, work on a payment schedule or something to pay the difference, or we'll go after you. And that's where bankruptcy usually happens right after that. But that's kind of the next step of foreclosure is some sort of pre-foreclosure or some sort of short sale. And then letter L, have you had a property foreclosed on in the last 7 years? So it went through the whole process, the waiting periods, courtyard steps, sold it, you had to move out, all that type of stuff in the last 7 years. Now, keep in mind, if you have had that, that doesn't mean you can't get a loan. That just means there's waiting periods, additional documentation, dates we have to resolve, and usually a hit to your credit that we have to work on to try to get your credit scores back up. But just because you've had a foreclosure in the last 7 years doesn't mean you don't get a mortgage loan. It just changes the type of loan you're going to get, and it just has some waiting periods that are built in. So then the last one, section M, have you declared bankruptcy in the last 7 years? When you do hit this one here, it'll give you a different classification. Let's say it's yes. You can do a comment on what it was. And then right here, you have the different types of bankruptcy that are filed. So a Chapter 7 is most commonly where there is no payments made to the trustee. Maybe you have to give back the cars, the house, assets, stuff like that. You have to give back as part of a Chapter 7. Where these other ones, 13, 12, those are business ones. 13 is most commonly where you're making payments to the trustee. So you go into bankruptcy, you kind of keep all your stuff. They restructure what your payment is. You make the payment to the trustee, and that money gets dispersed to the creditors. So there's different waiting periods depending on what type of chapter of bankruptcy that it is. But again, even if you had a bankruptcy in the last 7 years or 10 years or whatever it is, it doesn't prevent you from getting a loan. Again, there's waiting periods, and maybe some documentation will have to prove that it's either discharged, payments made on time. In fact, I've actually done loans for people in Chapter 13 that they've been making their payments, and now they can actually get out of it because their scores are better. They have equity in their home. We can actually pull out equity of a home to pay off a Chapter 13. So if you're in that situation where you've gone through a bankruptcy, there is options to actually refinance while you're in the 13. Seven's a little bit different because of the way it's discharged, but you don't have to wait 7 to 10 years to buy a house. And here's one of the best tips I can give you. If you had to go through bankruptcy because of job loss, health, income, whatever it was, death in the family, whatever it was, we have a lot of ways to help you get ready to buy a home again if we start sooner. You can always be working on your credit. There's other things you can do to make sure that's just all updated on your credit file. So that way, as soon as the waiting period is over, you're ready to buy a house. But I see too many people will wait 10 years or 7 years or 5 years or whatever it is. And then they start to want to buy a house and they haven't done anything to fix their credit. They haven't rebuilt anything. They haven't paid stuff off. They haven't updated the credit bureaus, none of that stuff. And they're not ready to buy. So they have to kind of relive that whole horrible bankruptcy again, that they just would have been kind of working on it from the beginning. They'd be ready a lot sooner. Their scores would rebound. It's just a way to kind of get around that situation. So keep that in mind if you are or have gone through a bankruptcy. Doesn't prevent you from doing a loan, just changes the guidelines. So let's go to next. This last section is called the HMDA report. This is a report that ties to my license, our company's license, to make sure that we're offering credit to everyone. So you don't have to answer these questions if you don't want to. Ask for your race, ethnicity, gender. The whole idea is to track me to make sure that I'm offering the same credit opportunities for everyone. So if they don't know which clients I'm working with, they don't know what my pull through rate is, what my percentage is. So say for instance that I take 10 applications for say Filipinos, but I only close one loan. But then I take 10 for say native Hawaiians and close 8 of them. They're going to look at that and say, okay, are you really offering the same opportunity for those different ethnic or racial groups or genders or anything like that? But you can see every one of these boxes, I don't wish to provide. You don't have to. I've had people tell me, hey, do I get a better loan if I say I'm Hispanic or Japanese or something like that? It's really more of a tracking of my license and our company to make sure we are offering the same credit opportunities to everyone, regardless of age, race, origin, all those types of things. So you can fill that out if you'd wish. We hit next. This right here will give you a summary. So it goes through okay. You've got just kind of recap, make sure there's nothing else you want to change there. And then bam, you hit submit and boom, I'll get an alert. We'll review your situation. Again, we don't pull credit automatically. The system doesn't pull it automatically. I kind of review it with you. I mean, like I said, the last thing we want to do is have just this system just randomly pulling credit reports without talking to the clients first, get an idea kind of where they're at, just see where their application is, see if there's any other red flags that just have to address before we actually just start pulling the credit. And we can pull a soft credit pull instead of a hard one, depending on time frames, kind of where you're at on your situation. But I'm telling you, the sooner you can start this process, the sooner you get the application in, the better you're going to be. You'll be faster on your offer. I mean, your offer will stand out if you don't need 45, 60 days to close because you're working on credit or working on this or that or working on all kinds of different things. Get started sooner. If it's on your radar, you want to start this process sooner. If you're self-employed, you want to start it sooner. If your lease is going to expire in June or May or April or something like that, get this process started sooner. You'll always find better loans or make it smoother because we can start gathering up this documentation so you're ready to go much faster. So as soon as we have the appraisal and the home inspection, bam, you're ready to go. So your offer can be shorter. It can stand out more. It can maybe get you a better price on the home. I'm telling you, this is such a crucial part, and so many people don't even want to do this step because they're worried about credit or bankruptcy or income or something like that. It costs you nothing to find out what you qualify for or what we need to do to get you to be qualified. I've had a lot of clients that are ready right now. I've had other clients that need about 2 or 3 months, just kind of tweaking their tax returns or their credit or down payment or starting a new job or all the things that are out there. So the sooner you start this process, the sooner you will be ready to be a homeowner. I want to help you in 2024. So check out my website, ryanbolton.com, right here. Nice, beautiful website. You can go up here and either book a call. You can call me. Here's my numbers, or just apply right there and I'll reach out to you and we'll get this process started. So hope you have a wonderful day. This is the year you buy a home. I want to be a part of that process with you. So I hope you have a wonderful day and we'll talk soon.